Let's take a look at TUI. Now, TUI is a German travel company founded in 1923, and I see that stock is up 50% today. So I wanted to take a look at it, do a discounted cash flow model to identify the intrinsic value of the stock and see if it's a buy or sell. And they have $3.352 billion market cap, and they're trading at 287. So they have about 1.1 billion shares outstanding. And this stock trades over the counter. Over the counter means it doesn't trade on a major exchange like New York Stock Exchange or NASDAQ. And the reason some companies do over the counter is because they don't have to pay the exorbitant filing fees. Just to be listed on the New York Stock Exchange, a company has to pay $500,000. And to be listed on the NASDAQ, a company has to pay $75,000. That's a one-time fee. And then they have to report certain financials, which there's a cost involved. You have to hire more accountants. You have to, there's more due diligence involved. So it's much easier to trade over the counter, although you're less likely to get as many investors. There's less liquidity, and it's considered more risky over the counter. So let's see their free cash flow. And it looks like it's pretty decent. And let's see their net income. And it did drop, but it's positive, which is a good sign. And their revenue. And the way foreign companies trade in the US markets is through ADR, American Depository Receipts. So it looks like their revenue increased steadily, then dropped a little in 2019. So now we calculated the free cash flow of the company. Now let's see their capital structure to find out their WACC. And their interest expense is $149 million. And the short-term debt, it's important to look at the debt of a company because you want to find out if they'll have room to borrow more or if they're highly leveraged. So $75 million of debt that's due within a year, and then $1 billion of debt that's due after a year. So they pay a hefty interest rate, 12.7% on the debt. That's not a great sign, but maybe that's just how foreign companies, maybe they just pay a higher rate. So their income before tax is $691 million. And their income tax expense is $160 million. So 23% is their effective tax rate. And so the cost of debt is deducted from their taxes. So they actually pay 9.8% on the debt. And now let's see the equity, 1.46 beta, so moderately volatile. The cost of equity is 13.46%, so their cost of capital is 12.5%. So based off of our calculations and when we present value of the cash flows, the company's worth $2.4 billion. And when we divide that number by 1.1 billion shares, the intrinsic value is $2.07. So it's considered a sell. So you can see today it's up 54% because it's up $1. So some people are bottom feeders. They see a low stock. They see, like in this case, look at the stock. It was like trading at $12, $13. Then it dropped to around $7 in the past few months. And then it dropped really low to $2. It's come back up, but we consider this a sell, $2.07 intrinsic value. And this is a travel company, so travel may not be as common now with coronavirus. It may take them a while to get back up on their feet. and a lot of other analysis needs to be done before purchasing a stock. But let me know in the comments what you think. If you want me to do another video, thanks for watching.